This is called the main trend, and these are called the retracements. This is a small retracement. In a way, it is called a running retracement. This is also a retracement. There are small retracements, deep retracements, which I talk on retracement topic, Fibonacci. Now, we need to buy things on retracement. So, and with the help of RSI, how do I know that? And I need to see reverse divergence. If I get a reverse divergence, then I get a confirmation that I'm on the right track. So for simplicity purpose, right now, I'm going to change this chart into a line chart. Okay. Now, and let me just break the chart into training mode. Okay. Now this, if you have not known this, it's going to completely blow your mind. And if you know this, it will be a good revision for you, right? Keep sharing, keep tagging. So, okay. Now, if you see this, you have an uptrend. See, market made a new high here, and RSI made a lower high. That is called as usual normal divergence. See, markets are going up, and RSI is going low. This is called normal bearish divergence. Now, let me just break it down. One more important note you can take down. Whenever you talk about divergence, normal divergence, which you know, which is a conventional way, you need to work, you need to say bullish divergence and bearish divergence. And whenever you're talking about reverse divergence, you are going to say positive reverse divergence and negative reverse divergence. So one is bullish and bearish, one is positive and negative. So there's no confusion in divergence and reverse divergence. Initially there will be. So watch this video 5 times, then it will get clear. Now this is a normal bearish divergence. Now if you know the conventional part of RSI, which I used to know before 2008, then you will look at divergence and you'll say, okay, markets are going to go down because, and already you think that this is too much. Whenever market goes up, you think about it's going too much. So you keep looking at the top and you keep looking at the divergence. And then market goes down for some time, maybe like this. And you are happy. Oh, wow, I got confirmation on the divergence. So I should short, right? So this is normal. So in a way, I'm not only teaching you reverse divergence, I'm also teaching you normal divergence, which is bullish and bearish. So are we clear so far on the bearish divergence, which we have so far, right? Are you guys learning something? That's a bearish divergence on RSI, on weekly chart of Maruti in the last couple of years. So people who only know divergence, they will sell their position in Maruti and get out and say this is done. But people who know reverse divergence. Now, how do we know reverse divergence? Let's talk about that. Okay, so now we have normal divergence. Market came down. People who are conventional, they are happy. They say market going down, divergence, trend going down, and I sold my position in Maruti. Now, people who know the unconventional RSI, which is very few people, and there are few books have been written on that for the deviation. Okay, so now let's get again, divergence is higher high, bearish divergence, and lower low. So that's normal bearish divergence, conventional people. Now, where do unconventional people look at is, let's see this one more bar. This is, now look at this one. In an uptrend, when you compare the lows, can you see that the price is higher, higher high? That means an uptrend, but RSI is lower. That means RSI is basically momentum, or what we call as force or speed. So let's mark this as, okay, let me mark this as A, and let's mark this as B. Okay, so this is A and B. Let me put it this way. B is higher and A is lower. And if I have to say there is A here, okay, I need to write it again. A and B. Okay, so you see the difference now. Watch this chart for like 20 seconds. What I'm trying to show you. A and B. B is higher than A on RSI, and A and B is lower. Sorry, it has to be here. We are comparing what? Can you see that? We are comparing the lows, the swing lows. You see there is a swing low here, there's a swing low here, there's a swing low here, and there's a swing low here. So one is higher, one is lower. What does this mean? That at B, listen to my words, what I'm saying. At B, there was a greater pressure or force to go down, which is on the downside. In spite of that, the price did not make a new low below point A. That means B is a oversold area. Now, if you are traditionally using oversold, overbought, you'll be surprised that I'm talking about oversold at 63 levels. This is real. This is the real meaning of oversold. Okay. Now, when I say this is best, now what is, there are a few more things that you can go into advance, and is that the reverse divergence. This is called reverse divergence, where price makes a higher high, RSI makes a lower low, and it's an uptrend, and it confirms an uptrend that it's going to go high and make a new high after this. So that's where I'm going to buy here at this point and put a stop loss below this, the swing low, and my target is going to be much higher. I will calculate the target. Let me talk about that later. Maybe we can do a session on that later. Right now, my target is somewhere here. Now, when I buy, I'm buying cheap. So I'm not buying a breakout, I'm buying a support. And my stop loss is very small compared to the risk reward ratio, which is 1:3, 1:4. Okay. And then we see what happened is market goes and maybe hits the target. And then what happens is keeps going up. Now, look at this one, okay? Pay attention. Market made a new high. Those people who exited are feeling sorry about it, and they exited. Are you guys learning something? To check whether it's a proper this thing or not. So do you see that what is reverse divergence? In an uptrend, it is making higher top, higher bottom on price, and RSI makes a lower bottom. That's a reverse divergence.